All right, so welcome in today. Today could be one of the biggest days in crypto history around the Fed meeting, and we'll get a chance to dive into a lot of that, along with some altcoins. We'll take a look at some of that, Bitcoin, Ethereum, and really take a look at the outlook going forward around how the economy, but also how the Fed is going to address a lot of what's happening today in the markets. So, again, my name is Paul Barron. Welcome back into Tech Path. Joining me today, of course, is Aldo. Jumping in today, we're going to do a tandem on a Fed meeting, so this will be fun.
Yeah. Excited.
Yeah. A couple of things we're going to jump into today, just to get a precursor here before Powell comes on. There will be a lot, I think, of discussion around the banking issue, a lot of scenarios around CPI. We'll have a lot of inbound on this. Would still love to kind of get you guys' input on whether or not we'll see a 25, a 50, maybe a flat. Love to get your input, so make sure and drop some comments down below. If you have some questions, make sure and set them in over on the side. We will try to get to a few of those at the end, and then, of course, we'll get into some charts and stuff. I want to jump over to this first tweet. Game of trades. This is the Fed injecting around $300 billion. I'm going to zoom in on that for you guys a little bit. $300 billion into the balance sheet. This is week one for the bank bailouts. Liquidity injection now, of course, has driven all the S&P 500 bull run since 2009. Here's why it won't happen this time. This was a pretty interesting point that they looked at. And again, one of the things that really fed into this is the fact that most likely for quantitative easing, we will continue to see more injection into the balance sheet. So a lot of this, I think, is going to be played out in the coming weeks and months. First expansion since 2021. This is kind of showing a little bit of the result right there. And they kind of show some interesting thing here. This was 2009. The Fed's balance sheet had a positively correlated with equity prices in the past. So many investors expect the current balance sheet expansion will lead to maybe some higher stocks. That is going to be the question mark for a lot of this as to how the Fed adjusts out to what they're doing and trying to do with the current banking situation. As you guys have heard us report this week and over the entire week, there's a lot happening around the situation of the number of banks that could be setting on basically an insolvent basis, meaning they owe more or would not be able to pay or handle any kind of bank runs based on the investments that they've got into. All right, so it looks like
points.
Yep. 25 basis points came in. So anticipated, we'll see how Chair Powell comes in on this. Looks like, it's going 4.75 to 5, in line with expectations right now. So interesting. I really anticipated a bit of a pause here. I'm going to be very intrigued with how Powell deals with this scenario. And of course, we'll take a look at the markets starting to move on this. Evan, let's take a look at the Bitcoin chart quickly. I'm just kind of curious how that is holding up right now.
What I've been looking at right now, so we're hitting, obviously a pretty big place right here at 28.7, and right now price had a big candle up, a big wick up just to make a higher high here, and now we're seeming to be rejecting off of it a little bit. On the real short-term time frames, what you could look at is you have a trigger wave here on the 10-minute, but sometimes you could see bearish divergences on some of these time frames. Money flow coming out. This is a little bit the degenerate time frames coming down here. It really depends. I think a lot of what's going to happen in the very short term here is, how hawkish Powell sounds.
Right.
Does he say, we're close to pivoting, or does he say, we have a lot more to go? That's really what it's going to sound like. And on the macro, things have been looking a little bit better. What I want to show you kind of on the weekly here, money flow coming up. We're about to cross into the green in the weekly. If you look back where I circled here, this happened only a few times in history. November of 2015. This also happened June 2019, and right now where we're getting pretty close to the money flow. If you look here, you did come up a little bit higher. You did, have that. You were still in that, kind of accumulation phase. 2016 came down a bit. Same thing happened here. It was worse in 2019. You did come up higher. If it repeats like this, you do have a technical target at 40K. That is in the cards if the Fed pivots early. But then look at what happened. You came down a lot. So imagine this: the Fed pivots too early, inflation gets out of hand again, and then you recreate kind of a scenario like this and come back down at 20K, 25K towards the end of the year when the Fed has to maybe raise rates a little bit more. That's what I could kind of guess right now. And if we look just back on the really short-term time frame, This is a big point of resistance right here, 28.7 big point of resistance. Right now, I wouldn't be doing anything. And it depends how big of a gambler you are. If I was to do something, I would probably try to give a short entry a shot here with the stop loss above there, betting that Powell is going to sound more hawkish, but we really don't know. This is kind of a gamble right here.
Look at these wicks on my chart. I was just the ranging of wicks all the way down to a 28.2 up to a 28.8 right now. These are on the 5-minute chart. So interesting response. If you look at the early indicators right now, and again, we may see a little bit of a dip. This is really more of a long-term play, I think, for both Bitcoin among many other digital assets. If you've been listening to us this week, or maybe you're listening to our podcasts over on the Substack, is we've really focused in on the issue of what, if you look at what Arthur Hayes has been talking about, if you look at what Balaji has been talking about, there's a handful of pundits out there that are really leaning hard into Bitcoin accelerating in a big way, mainly because of the exodus out of the banks. So a lot happening out there. I want to jump over here to a couple of things. The 25 basis points are in. I want to get over here. This was an interesting topic that I think is one that we need to pay attention to, and this gets very concerning because of the fact that China is involved. So you've got now Russia and China basically coming together to use the yuan instead of US dollars to basically conduct trade with Asia, Africa, and Latin America. Though Russia is not I would say, a titan when it comes to an economic contributor to the US global economy, the fact that we have China and Russia starting to align, you also align with what could be happening in the Middle East with Iran. Then you look at potential emerging markets, which is what we're seeing in South America. Things start to look a little different. The question here will be how Asia truly links up. If they do link up with the digital yuan, this could be a bigger factor going forward. There was another couple of things here. Bank of Indonesia is now prepping to phase out Visa and MasterCard. This also more larger defection out of Western finance. That's another problem I think that's going to be coming down the pipe. This was an interesting chart right here. This is called the Benner cycle. This predicted the Depression, the World War II issue, the dot-bomb bubble. Let me pop this out for you guys. This shows you those periods when to make money. And remember, 2019 was kind of that period right there. We are setting on 2023 right here. You can kind of see it right down there at the bottom. I don't know if, kind of get zoom in on that for you guys just to see the range of what we're looking at. Potential mid-range here at around 2026 as the potential climb. And then, of course, the big one is going to be 2035. Can you imagine that being that far out, 12 years out for another big cycle like this? If this holds true, we'll see how all these many of these are just, chart. As far as Ethereum holding up, I want to take a quick look at the Ethereum chart. We saw a little bit of move early this week. Not bad. Ethereum cracked over 1,800. What are you looking at right now?
So the difference here, and we all know that Ethereum has been really starting to underperform Bitcoin for a variety of reasons. Number one, Bitcoin dominance has been bullish, been more bullish. Number two, there's regulatory FUD. But if you see here, this is a trend line right on Ethereum. This is on our 4-minute chart. Bitcoin kind of has already made a higher high than this area from an hour ago. Ethereum is lagging behind and we're rejecting from the point. Let's look at this compared to Bitcoin in the same chart. Bitcoin made a higher high here. See? Ethereum is lagging in a lot of ways. Also, if you go on some larger time frames on Ethereum, I want to show you, you're getting a pretty, this is more of a bearish sign for Ethereum that we're not seeing on Bitcoin. See the money flow coming out here with the bearish div. Fun fact, this is a lot of times how you're able to catch when something's coming up a lot in a bull run, how you're able to catch the top. Look at this pattern, money flow coming out with bearish divs, and see what's happening. We're kind of rejecting from top of the trend line here. If you look at Bitcoin, let's go on the 4-hour on Bitcoin. I want to compare a little bit. You're not seeing that. You're seeing a green dot. You saw the same thing. Now you're kind of nullifying it and coming back up. You're also seeing continuation with the money flow still coming up in the 6-hour. I think even the 10-hour has a green dot here. So Bitcoin is looking substantially better than Ethereum right now. This is probably it's not too often that Bitcoin looks this much better than Ethereum, so we're kind of lagging behind. If you want to look at really low time frames right now, I would, it's really risky. It's hard to say, anything could happen depending on what Powell says here, but it looks like we're going to kind of reject more from this area. And it seems like what may happen, and the people who want us to go to 40K, you kind of want this to happen. You want to have a healthy correction down to hopefully 26K, these areas, and to continue forward. You don't want to just go straight up. You want to repeat a correction like here or a correction like this and then come up a little bit higher there. That's what you're kind of hoping for. So you kind of want us to come down a bit here. That's what I think.
Yeah. This will be interesting because sentiment has been a little bit soft on Ethereum this week. We saw a little bit of a move this morning. Bitcoin, of course, had a bigger move on sentiment. If you're tracking our CPI, make sure and check in on that. I want to jump to this tweet right here from Balaji. He's kind of made the rounds a little bit here on a few shows to talk about exactly what and where he's been watching. If you have not followed this guy, make sure and check him out over on Twitter. He does a great job on really breaking this down. This is one of the previous technical officers for Coinbase. Infinite money is here. How we get there is a matter of history. Question is about how to get out. The Fed is launching their CBDC in July. This is a big factor. Have you noticed how quickly the Fed Now component kind of jumped onto the scene? And I think a lot of people might not necessarily be giving it that much credibility, but pay attention to this. These people that are talking about this, and I would agree based on just the research I've done and our team has done, this is starting to point directly into summer months as a very interesting time. You have about 90 days to exit. Now his statement, and you guys have probably heard this, it's been on a few podcasts, is that his thought is that Bitcoin hits $1 million in 90 days. I don't know, and it's hard because you never really hear this kind of rhetoric from him before. This guy has been super serious on the markets for so long.
You never hear rhetoric from him like that from anyone.
Well, that's the point.
It's like doomsday. Yeah.
So you have about 90 days to hit. So his theory is that CBDC comes in on Fed Now, and basically they're funneling all the depositors from these failed banks into a nationalized banking system.
Right. Okay.
So you pick the top four, JP Mega, you look at Wells Fargo, Citi, Bank of America, and that's kind of his theory is where this is going. And then after that, the potential is now you're going to a digital dollar. Printed money will go away within maybe a few years, and you essentially have no way out, meaning if they decide to cut that off and say, well, we don't really do business with crypto, which could get us into the States, which I think is going to be a very big scenario starting to play out because you've got Florida and Texas now already positioning from a legislative standpoint to protect Bitcoin holdings, as well as even miners and people who work in the industry. So that'll be interesting to see how that plays out. So he's saying that it will, after that, you're trapped in a devaluated digital dollar. It'll be digital lockdown or Bitcoin independence. So that is a factor. Love to get you guys' feedback on how you think this may play out for sure. I was going to try to find his tweet that he got into a couple of this. I think it was this one right here. Yeah. This was an interesting thread. Let me zoom out on this a little bit, but I want to bring this up. So this was a tweet that he did a few days ago, and he really drills it down. I did a podcast on this, breaking this whole component down. But essentially what he pointed to was 2008, the cycle that happened during 2008, the fact that we got lied to, and the fact that we've saw all these pre-indicators. It was as if somebody within the Fed was starting to kind of give a little bit of an indicator that these kind of things were happening. And then further in the point he hit here is really the reason, of course, of these bank failures is they got in on these, they used all the deposits to buy basically long-dated U.S. Treasuries, which essentially were kind of exactly what Sam Bankman-Fried did with altcoins, crap coins, and then they got hung out when people wanted their money back, and that was the situation that simply happened with Silicon Valley. And some other things he hit here, I think on was pretty significant. All of these data points are all pre-published scenarios. This, of course, was let me zoom out on that one right there. That was the reserve of the weekly remittances. And you'll notice this, of course, in that massive downturn right there. Then you go over and take a look at the historical. This is happening in 2022 of unrealized gains. All of this data was available and had been out there. Nobody was reporting on it, and definitely mainstream media was not getting to it, but really diving into it on the Fed was showing this. So essentially the Fed knew this was coming, is his whole thesis. And if they knew it was coming, then essentially they held and put these depositors at risk, you, American depositors, at risk. And I think that's the bigger factor here that is really starting to play out in real world, which is, I think, is also why we've seen Bitcoin take a fairly significant positive move here recently. So lots happening. Here's this goes back to what I was saying earlier with Texas Senator Ted Cruz now introducing the ban to ban the Fed from adopting a central bank digital currency. If this happens to where, remember, this is a republic,
right?
So each state has the capacity. The only thing they can't do is run their own monetary system. It'll be interesting to see how that applies, especially when you look at Texas, Florida, and a handful of other states that might be flowing into this. In terms of altcoins, let's take a look over. I just want to see if anything is moving quickly.
So Bitcoin's still rejecting from that area. ETH is rejecting from the same area. So right now, I don't want to get too ahead of myself because we don't know what Powell is going to say, but right now it kind of looks more like this strategy that I've been looking at to potentially short based on money flow, good curvature, VWAP coming down here, combined with your lower time frame, your 90-minute, good curvature, money flow generally coming out. It looks like Powell may sound more hawkish. Maybe if he keeps bringing in that notion that we really got to keep raising rates until the job is done, we continue to go down. We can look at some of the altcoins here, such as I know a lot of people like Matic. Let's see if that's doing anything. That's actually up a tiny bit. Well, in the real short term, but if we go on to the three-minute down like everything else, you're kind of just following that same trajectory downward. But ultimately, very degenerate right here, but on a 4-minute time frame, you look at a little trigger wave hitting the point, looks like you could have more downward. I mean, if Powell sounds hawkish, this could, I don't know if coming down to 26K or 25K would necessarily mean ending the rally, but it could be the catalyst down, back to 26K, 25K here.
I want to jump to the chart on the Dixie real quick. Look at this sell-off on the dollar right now.
Oh, wow.
This is a chart. This is on the 5-minute, or I'm sorry, on the 30-minute. But even if you look back at that, Evan, I mean, that's a significant.
Wow, I didn't realize that.
That's a significant departure on the Dixie. With this being the case, so you look at the dollar valuation, the current scenario of what we're dealing with on the financial markets, what we might see in terms of some other banks that could potentially fall into this, and you see something that we've started to notice even within our own, circles here. And as you guys know, I do these weekend courses and seminars, and they're for high net worth individuals, business owners, and so on. And my last class, it was double the size.
Wow.
And this was just last Sunday. It was double the size of the largest class that I had done so far. It was 160 people in on this, all business owners. And now we're getting questions really for the first time, not about the idea of Bitcoin and crypto in general, but the idea of how do I move fiat to this. So they're literally, business owners are trying to say, I need to take some of this treasury and get myself into a hedge position a little bit better. I was very surprised with that in the sense that I had not seen this kind of behavior from a lot of these students before.
Yeah.
I mean, most of the time before it was simple. Explain why Bitcoin is, good money. Explain how the 21 million works. Explain, the idea of, proof of work. Basic stuff.
Yeah.
Now they're starting to understand. Okay, wait a minute. I've got a problem over here potentially at my bank, and that's the thing that was really surprising me, for sure. This is, of course, Governor Ron DeSantis is also looking at a 20-state coalition against CBDCs. This would be huge. Now, this will be interesting. Does and is Ron DeSantis maybe starting to set up a potential campaign analysis for a presidential run? Could this be a scenario where, a Fed coin or something could be the scenario
Seems like it,
of a play for him to say, hey, this is going to be on my campaign architecture. This is the other thing, guys, I want you to be very well aware of, and that is this situation right here with these. Let me zoom in out on that a little bit. 186 banks right now at risk of the Silicon Valley-like collapse. This is a thing, again, that Balaji has been talking about. There's a handful of guys that have been talking about. If you follow the All In podcast, the guys over there, including Sachs, Chamath Palihapitiya, Freeberg, and also Jason Calacanis, to a certain extent, they have a lot of the same scenarios. They're all VCs pretty much. And what they've been talking about is this VC reset. And what I mean by that is where a lot of these venture capital funds have really been bleeding in terms of valuation. So they're getting reset, and it's causing a lot of scenarios in the valley as to how they're going to go forward with its investing. Now, it could be also another boom time for how investing may occur. Bitcoin, is it looking any better right now? Let's take a look. We're going to get to Powell here in a few minutes.
So it looks the same. It looks pretty similar. I mean, this is the big, it's so hard to predict what Powell is going to say, obviously, but usually when you see a big wick up like this and a rejection, just basic, a lot of people are trying to short over here, trying to short this area. A lot of times, big wick up, get all those shorts out, and then you come down a good amount. Now, the question is, does Powell sound, imply that they're going to pivot soon and that brings us up higher, or does he sound more hawkish? We got to keep raising rates until the job is done. The technicals on the lower time frames, it's a little conflicting here. Technicals on the lower time frames, like the hour, the 30-minute, you generally have money flow coming out here. This would be a little bit more bearish, but when you go on the 4-hour, which is interesting, you're kind of nullifying the notion of money flow coming out, and you're getting a green dot, which could bring us higher. The other thing that's interesting, and this doesn't happen too often, this is 5-hour as well, is if you look at ETH, there's a significant difference. You usually don't see that. And ETH is really getting hit hard here. You're coming down while Bitcoin's holding some relative strength there. So, this is interesting too. You normally don't see this too much. You see the big candle on top, big candle at the bottom. I mean, that was bearish. Now you're seeing a bullish candle. So it's this is conflicting. It's going to be very interesting to see what happens. But with the 4-hour, this confirms an hour and a half here. This would generally be a more bearish signal. So, yeah, I mean, your guess is as good as mine right now. I would be, at least in the short term, not saying we're coming to back to 18K or something, but at least in the short term, I'm kind of banking on, if I want that price to go up, to continue up to 40K, I'm banking on a correction at least down to 26K, something right around there.
So your theory is that if we see an adjustment here based on some of the I'll call it the lagging indicators, for what happens after today's Fed meeting. And I think this will be the question. If he comes in with a hawkish view, meaning I'm still dedicated to busting inflation, it appears to me that would almost put a lot of damper on the S&P. Question is whether or not Bitcoin, even though there's a lot of speculation that Bitcoin has separated.
That's the biggest question in the world right now.
If it has, Evan, and you look at what's happened with the Dixie already, with a fairly significant sell-off, then you look at the scenarios that play into the idea that he's still pressuring here, meaning leading into possibly a pivot and a rate reversal.
Right.
Maybe by summer, depending on how this works. But at the same time, you've got this conflicting problem within the financial system of banks going out of business.
Yeah. That
just doesn't seem to balance very well.
It's a lot of, now it makes more sense about your tinfoil hat $1 million predictions in 3 months. But, it's a lot of things. And I think we're all still trying to kind of process, what just happened with SVB and all that, trying to kind of process all this. Look, what I want to show you on the macro here is just for people, kind of wondering, what should I do? I'll show you my main strategy for getting in. This is my long-term strategy. Look right here where we are in terms of money flow. I kind of circled at least close to it here. Money flow, times we come into the red in the 2-week money flow. These are about 10-month periods. If you don't count that little green there back in 2015. 10-month periods, I think, are the best places for DCA. So let's say kind of best case scenario, you do something like you did back in 2015. And this is really like Bitcoin, really depegs from the S&P 500. And I think most of us, or the vast majority of us, really agree S&P 500 NASDAQ will continue downward towards the end of the year. This is where it really decouples. You keep going up. Say you were DCAing in this area, for this 10-month period until, it went back into the green. You didn't miss out on too much in the run-up. You obviously didn't miss out. You missed out on a little bit, but not too much. I think that's the best course of action because that would hedge you very good in a way where imagine we get another black swan over here, another blood diamond here, black swan. fun fact, this is crazy how much it repeats. You had a blood diamond here, and that was started a bull run. Blood diamond here, started a bull run. We're gonna, once this VWAP comes down, this yellow line right here, we're gonna see that. We're gonna see at least a deep red dot here. After that, that could be a really good place. But I think 10 months right now, like for example, if I had 10K to invest, I would invest, $1,000 every month now, probably until January. I think that's the best course of action for long term here.
In terms of with that, and how it applies to what could happen in the altcoin market, because something we are watching for is the Bitcoin dominance. I was looking at the chart. This is on the 30, and it's starting to slip slightly. I mean, it's not much. I mean, you're going from a 47.7 to literally a 47.6. It's a tenth of a point, but these kind of candles do show up. It'll be a question mark as to whether or not we see this kind of fall off right here that we saw back here in, what was it? Yeah, March 21st through the 23rd right here. So that in itself could be a little bit of a downtrend that might recorrect. And if that were to happen, again, this is one of the things that money's going somewhere.
Yeah.
So my question is, it's probably, or my theory, probably not going into banks.
Right.
Could it be going into stables? Maybe Tether. Are people safe and feeling good about USDC again? I'm still questioning that.
I don't think so.
Yeah, I still question that. Right now the sentiment has been holding somewhat solid on USDC. We started tracking that in the CPI. Well, we've been tracking it. We just haven't published the chart. But we started publishing the chart on that, and it had been holding out not bad for where that's going. I'll bring that up. Let's take a look. I want to take a look at Matic real quick, because I know there's some things happening, obviously, with Matic. Lots happening this week. They just did an acquisition. We're probably going to break this down. Well, we will break this down for you guys around what happened over at GDC. I think Web3, if you think about Web3 in general, it has really detached. So Matic, what do we like?
So Matic looks, it's really, most of the altcoins usually look a lot like Bitcoin, but these look substantially worse than Bitcoin. Look at the 4-hour here, money flow coming out, double trigger wave right there. That would make it seem like Matic's going to continue downward here a bit. If also, the other thing to keep in mind here, this is not too often you see this. You only really see this in accumulation years. You saw this in 2019 a lot, which is similar to this year a lot. We didn't even get close to our February of 2019 high here. Bitcoin went well above it at 28K versus 25K. This is not even close. You got to $1.25 almost when your high was $1.60 about. So that's the big catalyst downward. So I think ultimately, in terms of Bitcoin dominance, I would stay away from the vast majority of altcoins right now. Sure, one here and there, a few here and there will outperform Bitcoin, but I think at least until Bitcoin dominance here, let's look at Bitcoin dominance, at least until this gets higher, and this is my kind of estimate trajectory, at least until this gets to probably this area, low 50s or at least 50%, I would be staying away from altcoins and just focusing on long-term accumulation for Bitcoin, which I think is the most important thing right now to be in a good position for the next bull run. You want to have Bitcoin, and then ultimately, I think the best place for altcoins is towards the end of the year. Towards the end of the year, maybe even into early next year, to get into altcoins, to get into Ethereum, to get into Matic, to all those. But right now, it's Bitcoin season, and then you make a nice buck with Bitcoin. Let's say it goes up to 40K by the end of the year, maybe. Then at that point, when Bitcoin dominance is high, convert some of it over into altcoins.
Yeah, and I think this is the question on, what is the mix of your portfolio? Because this is a question I get a lot. Again, not financial advice, how we do it. And one thing that has been happening for us is, for the first time, we've really started to look at our treasuries. And what I mean by that is just our bank accounts. Take a look at, is there an opportunity here to hedge right now with what's happening with Bitcoin? And we did make that move here earlier as Bitcoin was around 20K. And we saw the fall off at SVB. Once that occurred, to me, the light went on and said, all right, we are in a financial crisis. This is another red letter day.
Right.
We're probably going to see more of these kinds of scenarios, but I don't know that Bitcoin, this is a different kind of FOMC meeting that we're getting ready to hear coming in. And that is because it is, for the first time, a scenario that we've actually broke something. And that is a financial system. We've taken what was a very liquid bank, possibly one of the best banks in the country when it comes to funding startups and the heartbeat of entrepreneurship, and pretty much created it in 48 hours. To me, that starts to really question how all of this plays out. As I was going to show you guys, it looks like he's getting ready to come on here in a few seconds. if he does come up here. I want to just show you guys the current Bitcoin. We just published the Bitcoin. Let me get back over to it while we're waiting on Chair Powell to come on. Let's jump over to the Bitcoin sentiment chart as it paints up here. We just published, we're going to publish sentiment twice today. So our first sentiment print happened this morning. Bitcoin holding in right here with a growth over yesterday's print. Today holding out and literally on top of each other right now, both AMP and top line sentiment. And as you guys know, if you follow our channel enough, we track sentiment more. So let's stop and listen to what Powell has to say. Looks like we've got a little bit of, or they're lagging over there.
I'm reading somewhere the Fed says they're going to continue reducing their balance sheet as planned. So
yeah.
Some of the notes do seem, preliminary notes do seem a little bit more hawkish here.
All right, so we're going to try to bring this back in real quick. One of the guys is having a little bit of difficulty. So far, the data that is coming in is somewhat neutral right now as Powell is starting to address kind of the situation. And I think, the one thing that needs to happen for us to kind of move forward, obviously, is how he addresses and deals with the situation going forward based on the financial scenario. If he's going to make some decisions around that, that'll be the question mark, I think, that continues. And, a lot of times within these Fed meetings, we'll get, the questions from the gallery, which is, of course, all of the primary financial reporters that are out there pulling in. Let me see if we've got it back just yet. Looks like we're still having it. Go to...
Market is reacting slightly more bearish to it so far. So that rejection off the spiral line at about 28.8 is holding up so far. Things in the lower time frames do look a bit more bearish in my view. However, we'll see.
Are you able to cut into a chart?
I could talk about some stuff here. Yeah, okay. So let's see. Right now, we're not seeing. So preliminary of the reaction to this speech is a bit more bearish. Still a pretty decent rejection off of this area. So you look at that, and then right here, this is coming down. You got a high anchor wave right there. So yeah, hourly would look a little bit more kind of on the bearish side there. 2 hour money flow coming down. So I still think, it still looks, unless they throw a curveball at us right now, still thinks like we should have some type of correction down to hoping 25K, and I hope that we come down a bit more.
Inflation remains well above our longer run goal of 2%. Over the 12 months ending in January, PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. The change in the CPI came in at 6%, and the change in the was 5.5%. Inflation has moderated somewhat since the middle. Recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a range of survey forecasters as well as measures from financial markets. Monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that inflation poses significant hardship as roads, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate, at which point bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our security holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will collect data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, inflation, and decisions will reflect. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what participant judges to be the most likely forward. The economy of participant projects 1%, 4% at the end, and 3% projections, reflecting offset. If the economy does not, as projected,
That.
our maximum employment, we will continue to make our decisions incoming data for economic activity. So, I guess our view FDIC, which is depositors' savings are safe, the system is safe, stabilized over the last week. And the last thing is that we will a review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our. We also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. And financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes maybe, some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So
It could further exacerbate the problem in the banks?
Focused on economic outcomes, on this credit tightening, what can that produce in the way of tighter credit conditions? I think when we think about the situation of banks, we're focused on our lending facilities, and also the facility.
Nick, Street Journal. On your you had indicated you thought the term for the stress in the banking sector, and I realize there's a lot of uncertainty. Can you explain at all to what extent your forecasts or those of your colleagues incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would
Yeah, it looks like we're
still
still
catching
some issues
in
and out of these feeds from the Fed. Anyway, I think the scenario that Powell has pulled in on is pretty straightforward. The situation still looks to be as though he is going after inflation pretty much full frontal here. So I think obviously what we've seen here with Bitcoin starting
in a way,
coming back
the data in the first part, the first 5 weeks of the intermediate period,
guys.
pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part kind of the possibility of
the struggle stream is real.
credit conditions.
Yeah, I mean, we almost got to a big area at 27.7. We didn't quite
Well, it
hit
dumped and then came right back.
It came back a little bit. Not
Is
all
going
the
to
way
be enough
back. We're still down from
tighter
the
financial
high
conditions
at,
that you believe will be necessary
2
without
p.m. at
doing
almost
significant
29.
damage to
So,
the banking sector?
you know,
Have you, for
it's
example,
obvious,
considered
it goes down
changing
this
reserve
straight line,
requirements,
up this
selling
straight
assets
line.
out of the
So
system, open
I
market
would
account,
even- we're also seeing
as a
maybe
way
about
to
the
better
4
achieve
hour here
tighter
where
financial conditions
money flow
that
is starting
don't
to come down under
accelerate
4%.
deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Howard.
Chair Powell, Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really 3 parts, right? Goods inflation's been coming down now for 6 months. It's liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand, perhaps softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. To your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustainable will it be? That's the issue. and we don't really see it yet. It's so people are making estimates, people are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
On the 5-minute chart, looks like 2 green candles coming back. So very interesting kind of feedback, I think.
Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our
we're seeing,
questions. I wonder if you could talk a little bit. I know that you've got your internal review coming, but I wonder if you could talk a little bit. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors concentrated in a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so again, and then implement those policies. My views on what the answers might be. I simply can't do that. Vice Chair Barr is reading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, it's clear that we do need to strengthen supervision and regulation, and I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened, and so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. You're looking at it given that you're now thinking that moves might be appropriate as opposed to ongoing.
So we published an SEP today, as you will have seen, and it shows that payments expect relatively slow growth, a gradual rebalancing of supply and demand, and moving down gradually. In that most likely case, if that happens, participants don't see rate cuts. They just don't. I would just say, as always, the path of the economy is certain. Happens rather than what we write down in the SEP, but that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that. In a way, that's substitute for the key is we have to have policies got to be tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern to risk commercial estate and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk to mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we've well aware of the concentrations people have in commercial real estate. I really don't think the banking system is strong, sound, it is well capitalized, and really see that as at all.
Would you be open to an independent investigation separate from the Fed's probe?
I welcome 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, percent.
Mr. Chairman, Edward Lawrence from Fox Business. Inflation has been rising, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that. So we get inflation down to 2% in time.
But the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
At the impulse from spending, because spending was, of course, tremendously high during the pandemic, and the pandemic programs rolled off, spending came down. So the sort of fiscal impulse inflation right now. It was at the beginning perhaps part of what was driving inflation, but that's not really the story now.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on weekends ago. First, why is this new bank funding facility under discount window, changing the terms of the discount window in time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So under Section 13.3, we've done quite a lot under the discount window as well. We needed to do a special facility that was designed to certain 13.3. Is the right place. Lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
No, absolutely not. No, if we need to raise rates higher, we will. I think for now, though, we of tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well. So far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Mr. Mike, please.
Yes, sir. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, and because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have a long, we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see you see the benefits of wages, space that we should try to get back.
Get news. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just simply to say whether there really have been changes in that. the question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in standards ability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Nancy.
Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, in particular immediate attention. And I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
It's part of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure, but it's not today.
So you don't have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, this review is going on, and I want nothing other than us to find out what happened and why, figure out what we implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet. That's something we've discussed yet. As I
yeah, so lots of hawkish information
Curious,
here right now. This is going to be an interesting wrap up here as we get into a lot of things to talk about here.
So,
more than index. They don't necessarily capture lending conditions, though. So there are other measures which if they're, bank lending conditions and things like that, they show some more tightening. Though is how significant would be the duration of it. Once you know that, there's a fair amount of research about how with broad uncertainty bands, how that works in period. And so, so we'll be looking to see first the sustained, and if it is, that into our policy. Rate cuts are not in our base case, and so that's all I have to say. So, thank you very much.
All right, so we'll get back into this here. All right, so wrapped up today, I think the situation is pretty clear, is that Powell is on a mission, and he's on a mission to destroy the economy.
Yeah, it looks like it. I mean, if you look at the new development on the 4-hour chart right here, money flow coming out, you have bearish divs, so it's definitely looking a lot more bearish. Big rejection from double spiral lines. I don't know if you guys can see at 28.7. The next big significant place is kind of where we are right now, that we're playing around with 27.4. If we lose that, you don't have much until around 25 mid to high 25s. So
that would be the next catch.
That would be the big place
Yeah.
to catch it. You'd hope for a healthy correction down there, continue forward, unless Powell could get to us and bring us down farther.
Well, I think the other aspect of this that he has presented today, and that is the issue that they're still going to forge ahead to try to get to 2%. That's the number one thing.
Mhm.
The other thing, too, is right there at the end, he said, hey, rate cuts are not in our position.
That's
So
hawkish. Yeah.
that in itself, it's not even like, hey, we're not even looking at a rate cut. You know, okay, maybe a pause. That's even putting words in his mouth.
Yeah, yeah.
But at that point, now you've got a scenario which I think sets up a very, very precarious position, I think, for both the Fed, but more importantly for the market and the economy,
Mhm.
is if we see any additional pain in the financial sector. So he's done this. We're going with the 25. Yes, I'm going to get to 2%. It may take me longer than I anticipated, like the end of the year, but I think he's pushing into 24 on this. And, you know, we think we've got backstops covered here on the banking system, but he wasn't necessarily selling that in as to, it was almost as if, hey, if we do see some of these smaller banks, you know, crater, so be it.
Right.
And we're moving on into the banking
Yeah.
or into the recessionary period, which is the thing I'm concerned about right now. This is, again, what a lot of people have been talking about. I'm a little bit surprised at Bitcoin's correction with this, in the sense of the fact that Bitcoin could still be a potential flight to safety.
Right.
And if we continue to see a dollar sell-off, if that is the case, and if we continue to see pressure on the financial system, which is the bigger point,
right,
could be just a simple, you know, scenario here where traders are taking profits.
Yeah, I think,
and
there's
moving in and out.
also the notion that, everybody's safe with a bank, even if the bank goes down, FDIC insurance, the Fed's going to watch out for you. That kind of brings Bitcoin down, at least in the short term. Also, not the best sign for Bitcoin that the Dixie is coming down a lot and
Right.
Bitcoin's not really coming up, which is what we saw right now. So, does that mean we're going to come down to 25 or much worse down to 20? That's the real question.
Yeah, the Dixie bounced
Yeah.
off of $1.02. So but that was down from $1.03. We hadn't seen that number in
Right.
quite a while too. So that in itself, I think, is going to be a no. Listen, very sorry for the feed, guys. We're going to definitely do a full wrap up as we get more additional information. But more importantly, the amount of research now I think that we're going to have to be doing to really take a look at what this forecast might look like, especially on Bitcoin. We're going to drop our sentiment data again later in the afternoon to take a look at that, because I have a feeling that we're probably going to see, because we wanted to see a post FOMC sentiment and a pre-FOMC. Pre-FOMC was still climbing,
Yeah.
much like the charts were in
Right.
advance when we printed that early this morning. So I don't know if some of you guys were able to exit on some of your Bitcoin trades at the top at around 28.7, not a bad look. 28.7 would have been a good one. And then of course right now Bitcoin holding in around 27.4. What are your thoughts on this, Evan? Do you think the 27K holds?
Probably. Well, the next big place is the place we're hitting right here, 27.6, and we're not really holding this area at the moment, so that's not the best sign. Also, this is a huge kind of rare bearish area that we're seeing right now in the 4-hour. Big kind of bearish div, money flow
Right.
starting to come out here. That's the number one way to usually catch the top of rallies.
Mhm.
We also saw a pretty decent rejection off of this double spiral line, which is kind of where I went short, around here. I had a stop. I don't want to tell you where the stop was, but it was well above where we wicked up to. But, we're hitting some traffic right here. That's 27. It makes sense to come down more. Typically, you do come down more and retest, big areas such as the 200 weekly moving average at 25.5 right around here. If you look at the daily as well, this is pretty bearish on the macro. Your money flow coming down, VWAP coming down with it. That's in the grounds for a decent correction here. Even historically, this is like big places, big corrections. Last thing I'm going to show you real quick here is the 90-minute generally having money flow coming down. Let's just look at typically what this time frame gives us. Money flow crossover right here, big jump up, and then money flow crossover could bring us right back down.
Yeah, for sure. Did we end up getting a poll on this one? No? All right, so guys, this is pretty much a wrap for today. We will get back with you again with some additional research. We'll do a full follow-up on this. But I think the short takeaway is, yes, bearish indicators here right now. Whether this holds, though, based on the financial condition of what is happening within the marketplace, is the question mark. If Bitcoin does not fall too much, then we may see a stable catch here. The question will be how sentiment plays out on this, and of course, how trading volume. So we'll be tracking that pretty heavily. Of course, if you guys are not in the Diamond Circle, make sure and get in on that. If you're not subscribed to the channel, make sure and click subscribe right now. It's one of the best ways that you can get notifications of live streams just like this. If you want to reach me, it's out there on Twitter. We'll catch you next time right here on TechPath.